Happy Wednesday. Welcome back to another week of the Educated Homebuyer Live with Josh and myself to answer your mortgage and real estate questions to help you become the educated homebuyer. So, what's happened since last week? Not a lot. Nothing really happening in the news. Mortgage rates tend to be going up for no reason at all. Life is just dandy out there. Josh, are you aware of anything that's happened in the last week that would affect markets?
I don't know. There was news shows and there was fireworks last night going off at 11:30 at night.
That
So
was
who knows?
the Angel Stadium.
It was the Angels. It's not Angel season.
Yeah,
and they don't win. So I don't think you get to light fireworks off when you don't win.
No, so clearly we had a new president elected, which we're going to talk about in tonight's episode.
But was he new, Jeb? It seems like it's an old president.
It is an old president reelected, which we're going to talk about a little bit in tonight's episode. We're going to talk about mortgage rates, which we've seen them tick up. Tomorrow, we've got the Fed coming out. We're going to talk about how all of this is going to impact the housing market, and it might impact you as a buyer or seller. So while we're talking, start putting in the chat where you're watching from, your questions, so that when we're done, we can get to your questions, make sure we can answer them before tonight's episode's over. Reminder, we do this every week for 1 hour, starting at 5 p.m. Pacific Standard Time. So with some time changes, I realize some states don't change times, Arizona being one of them. I think there's a couple others out there, Josh. So we're different on their schedule, but still here the same in California, 5 p.m. So
it's always confusing the Arizonans that are lucky enough to not have to deal with this crap like the rest of us.
Very, 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 very true. So let's do this, Josh. Let's take a look at some charts, as we always do. And we're going to start with inventory. So inventory actually ticked down from 736 down to 735, 718. Let's see, 29.8% more homes on the market than last year. That's down from 40% more in September. More and more listings being pulled from the market. It's that time of the year. And we are going to take a look here at Orange County and Huntington Beach. So Orange County, 3474. My guess is the peak is in for the year with inventory at this point. We're down 2.07% week over week. Huntington Beach is actually exactly where it was last week, 232. We actually had 6 homes come on the market today, Josh, and we're still sitting at that 232. So we're either having homes, come off the market, homes go under contract, whatever it is. But at the moment, we are sitting the same. And that's going to push us into new listings. So new listings this week, 61,000 unsold, plus another 9,400 that were immediate sells. And then let's take a look at contracts pending, 354,000 single family homes in the contract pending stage now. That's 14% more than last year at this time, which is actually a little bit surprising based on where rates were this time last year. But both buyers and sellers have increased 63,000 new pendings this past week. And then the median price of new contracts sitting at 389,900. Unchanged for the week, and somewhere between 5 and 6% greater than last year. And our last one we always look at is price cuts. Price reductions sitting at 39.4%. And we're at the point now, Josh, where we're in the next week or so, we're going to be lower than both 22 and 2023 when it comes to percentage of price cuts for this time of year. And again, kind of normal, just based on some seasonality finally coming into to play. So foreclosures and bankruptcies. This is something we hear a lot of, not necessarily the BKs, but more so the foreclosures. So I threw this chart in here, Josh, just to give some context to where foreclosures are. We hear, hey, they're increasing. Yes, they are increasing, but you have to understand where are they increasing from. So increasing, but at a very, very, very modest increase. I don't even know if modest is the right word, but you can go back and look at this chart here compared to 07, 08, considerably. Not even comparable between the two, but that's where we are. Foreclosures being the dark red and bankruptcies being the lighter color there. Both are increasing though. This is the chart, Josh, that you and I have talked about. I've mentioned this in another video, but 40-year change in statewide home prices. You often hear us talk about how real estate's a long-term game, right? Buy and hold, your grandparents bought a house for $30,000. It's now worth $1 million. How? Because of this, right? Long-term appreciation. I think the winner in this whole thing was Washington State being 810% over a 40-year period of time. Maine was up there, which was very surprising to me. Probably the biggest surprise out of all of them was the fact that Maine was even, considered in the top 10. But you got California at 655%, Texas over 300%, Florida over 500%. So really interesting chart. So
there's a couple things that I think when I look at this, just strangely, invest in the corners of the country. You would have
Coastal,
done well if you went to the coastal. But I mean, look, California, Washington, Maine, Florida are about as good as it gets. There's a few others in there that are really good. But for those of you who follow us and watch and reach out, hey, I want to invest. I'm in California and no investments make sense. I'm going to look here, there, everywhere. Jeb, you and I have talked about Indiana. My mom owns a rental property in Indiana, closed a refinance for a viewer last month, and he owns 3 in Indiana and is looking to buy more. But when you look at that, 300% gains over 40 years on a leveraged investment like real estate are nothing to sneeze at. But you definitely do in so-called flyover states. You're going to see far less appreciation. But when you're chasing rent yields, because the rents are higher relative to the home prices in those lower price states, you're giving up something to get the yield. It doesn't mean it's not a good investment. I think we've talked here on the show. I got a acquaintance that owns like 1,000 doors in Nebraska, and he's perfectly okay that he's not going to get anywhere near the appreciation as if he owned them in San Diego, because he'd have about 10 doors in San Diego instead of 1,000 in Nebraska, and the rents bring him in like $80,000 a month on those. And it's not easy to acquire 1,000 doors, but if you do it, it can be lucrative.
Or manage 1,000 doors.
100%.
So today, Josh, we had the stock market jump considerably. At the same time, we saw bonds just get crushed. In fact, the bond market prior to the market ever opening this morning was already crushed because of what, Josh? What happened that crushed the bond market?
This is what is amazing to me, Jeb. We have talked about over the last 2 years, sort of conflicting data. You see something that says this is going to happen, and then something says this is going to happen. I mean, literal statistical data, just mixed signals, mixed messages, and it has been very hard to read. Well, the election was a microcosm of that. Over the summer, Joe Biden is the nominee for the Democratic Party, and he obviously has dementia. So it's going to be a Trump landslide. Then they nominate Kamala. I always say that wrong. I get in trouble. You guys like to yell at me for that. So Kamala gets nominated, and then it's the opposite. Trump doesn't stand a chance. Kamala, hope and joy. Everyone loves her. She's going to have a landslide. Then it circles back, and we're going to have a Trump landslide. And then last weekend, you saw the numbers. A poll comes out in Iowa that was supposed to be one of the most respected polls that says she's ahead by 5 points when everything else has her down by like 4 or 5 in Iowa, a very consistently red state. So just again, mixed signals all over the place. So I don't know about you guys watching at home, but Jeb and I talked about this yesterday. We left here going, I have no idea what happens tonight. I've got so many mixed messages and conflicting reports that I have no idea what happens tonight. Well, we got what the betting markets were predicting, over the last month or so. Trump wins. The Senate has already been called for Republicans, and it looks like they're going to get Congress. It's still, there's going to be 5 or 6 seats that's going to take a week or 2 to settle out, but it looks like most of those are in states that Trump won, which would imply that the probability that they're going to have a thin margin in both the Senate and the House, and they've got Trump. So what does that mean? You see, let's look at a couple of other headlines. So that was the Wall Street Journal. Dow jumps, bonds tumble. Pretty obvious. So resounding Trump win unleashes massive risk on trade. So what does that mean? Money coming out of bonds, money going into stocks. So for today, that was the response, and it would have been what anyone would have predicted if we got that result. So not out of the norm. And part of what you need to understand with that is that stocks and bonds compete. There's only so many investable dollars out there. So if stocks are going to go through the roof, bonds are going to suffer. So there's a secondary piece of that. We'll kind of just, you and I are going to do a deep dive on the podcast. We're going to record tomorrow. It'll be available next Tuesday. But again, just sort of another headline here. Jerome Powell back in Trump's world and about to feel the heat. So for those of you who don't remember, Trump, he nominated Powell, right?
I believe so, yes.
And then for 4 years told him he's an idiot and he needs to cut rates. So we'll see what that means. But this is kind of a little bit what you and I are going to talk about tomorrow, Jeb. Some of the pros and the cons here. Pros, people think lower taxes. People will have more money. Deregulation. We talk about the extensive regulations that keep people, builders, from building as many homes as we need. Less housing competition. We talk about whether the number is 5 million, 10 million immigrants. I don't think a lot of the type of immigrants that are coming in, these are not H-1B visa holders coming in legally that are making $150,000, $200,000 a year and buying homes and competing with you in that way. But there could be some less housing infrastructure investment that in ways that would help the economy, help construction. The potential cons, we talked about inflation. Part of the bad news for bonds today is those lower taxes. There is a belief that will lead to more government borrowing, deficit spending will lead to higher inflation, higher rates. He's committed to tariffs. So lower taxes and tariffs are what we know. Deportation should be a positive for housing, but a negative if many of those people are working in construction. So just uncertainty overall. Those are the things you and I are going to go through in detail tomorrow, as much as anyone can know. A lot of this is unknown. It's conjecture. We know about lower taxes and higher tariffs. Other than that, the rest is going to be, guessing about the future of everything. This, Jeb, was a chart that came across my desk this morning. I thought this was pretty interesting. When we look at technicals, we basically have the unemployment rate, and then it's a 36-month average in orange. And when you get a crossover, you generally have a consistent upturn in unemployment going forward. And we've talked about that. If we want to get lower rates consistently and not just a little blip where we get 30, 60, 90 days of lower rates, we need to see a higher unemployment rate. Well, if you look at this, every time that blue line crosses the orange, we've seen a run up, an extended run up in unemployment. So not that we want to see people unemployed, but for those of you who want better interest rates, you definitely want a higher unemployment rate than the 4% that we have right now. Next week, Jeb, we're going to get a look at CPI. Don't expect a whole lot good. Actually, I should put these in reverse order. So the Cleveland Fed does their nowcast. They're expecting 0.18 for CPI for October, going up to 0.28 for November. The current month is usually pretty darn accurate, but that would give us a 0.2 read. But our problem is the October of 2023 has fallen off at a 0.1. So the next 2 months are about 0.2. So think about what this means. 0.2 on a month-to-month basis is 2.4% year over year if we hit that every month. So if we get that 0.2 again next month, you saw 0.28 is what they're forecasting right now. We're not going to see a lot of improvement over the next 3 months. The potential for improvement is January, February, March, April. But if you remember, bonds rallied on the belief this time last year that inflation was under control, and we got these hot reads. If those hot reads fall off and we get a 0.1 or so, a 0.2, we could see a number that is better by the spring. And this is why the Fed and the government themselves, they look at a 90-day average. They look at a 180-day average because they want to see what's happening and less about these base year effects. You can see in the spring, we had a couple of low reads, and then recently we've been here consistently at 0.2. So we'll see what that looks like going forward. You had hinted at it, Jeb. Tomorrow we get a Fed announcement with that 97% chance they're going to cut 25 basis points. Many people asking why are we cutting if the economy's hot? The bond market is saying yields are higher, stocks are higher. Why are we going to cut? They're going to cut because they pretty much told the markets they were going to. We're down to over the next 2 meetings, the probability that we will get another 25 basis points over the next 2 meetings, another 25 basis points over the next 2 meetings, and in the second half of next year, another 25 basis points. So again, this is a really volatile series. It is Fed funds projections. We are, I believe, in December. Jeb, is it December or the January meeting that we get the next dot plots? We'll see how the Fed themselves adjust, and we're going to get more data. Some of the data that came in this week is looking like GDP for the fourth quarter is going to be a little bit lower. Again, it's all clear as mud. So with this, Jeb, this is the fun part. This crazy chart, we enjoyed our nice downtrend for the better part of 90 days, and now we're going on 45 days of a straight line up. And the important line that we have is the red downtrend line there at the top. And we blew through it today, tried to recover, tried to get under it, and ended up just above it at the end of the day. The little aqua line there is 450 on the 10-year. If 450 doesn't hold, very likely you make a run to 475. So the trend is not our friend, but the trend is intact until it's not. So for now, if you are in the market, we had someone, Jeb, that reached out in the channel today that got a property under contract and said, hey, I got a property under contract. We're going to close in December. When should I be considering locking?
A month ago.
A month ago would have been a good time, but he just got a contract yesterday. Here's what I would say. If the mortgage advisor that you're working with can't give you insights, we don't have a crystal ball. I cannot tell you, but if they can't tell you when the risks are weighted against you, last night was probably the riskiest night to be floating an interest rate in the last 2-3 years. So if you're working with a mortgage advisor that knows that you got a property under contract, and they couldn't have a conversation with you and say, hey, do you want to lock it today? Because tonight's going to be pretty risky. If that red wave comes, rates are going to be a lot worse tomorrow. And in reality, we were only about 1/8% worse today. So in terms of a bad day, it was a very mild bad day, but it was a bad day indeed.
All right.
So where does it leave us? A little over 7 on the 30-year fix. So almost up, what, in 1 month, 0.6. I would say it's more than that, because we were just better. It might be just the timing of it. Give it another week or two, and if rates stay here, we're going to be up a percent over the month. So 6.5-ish FHA and VA, and looking a little over 7 on the 30-year fix. The well-qualified borrowers will obviously be getting a little bit better than that. For those of you who missed that refi boom, we're going to find out if Trump is long-term bad for interest rates. If we're at an inflection point in the economy, Jeb, we've talked about this on the show a million times. Presidents get way too much credit when things go good and way too much blame when things go bad. They don't control nearly as much. That headline from David Rosenberg in there, his main point in his newsletter this morning was, election cycles are election cycles, but it doesn't repeal the business cycle. And we are where we are. It's going to turn, and it's going to roll over at some point. Question is when, and what will that do for rates? So those of you who missed that window for being able to take advantage of those lower rates we had a couple months ago, 45 days ago, we have a rate watch where you can sign up with that. You use that QR code, use the link, theeducatedhomebuyer.com/rate watch. Just upload a little bit of information, and we will watch that for you and let you know when an opportunity arises, so you don't have to worry about it or worry about missing it if you're not watching it on a day-to-day basis.
And then lastly, the map that we show every week. The states in the red are the states that we can actually help in there. Those are states that Josh is licensed in. The states in the blue we can also help you in, just not directly. It would be setting you, helping you with, get you in touch with one of our mortgage partners there, David, who does those other states. So if you're in the red and you're in the blue, not politically, on this map, reach out using that description or that link in the description of the video. That's actually just the easy one is jebsmith.net/referral. So with that said, Josh, let's take a look at some questions this evening. If we have any, if you haven't done so already, let us know where you're watching from. It's always a good thing to see people from different states in here. We got Inglewood in the house. Inglewood's up there. Josh was in Inglewood last week.
I was in Inglewood, visited the Intuit Dome. It is a spectacular building. Unfortunately, my clips got out to a big lead and then frittered it all away in the third quarter.
Yes. That's pretty typical though, Josh. You seem surprised, but
it's not typical. Don't make me come over there and throw something.
Because usually they're not in the lead. Let's see here, Josh. David, people with money and assets will benefit the most for the next 4 years, which will be me. So yeah, I mean, typically, cutting taxes, Trump has been pro-business typically during, a pro-business cycle. Typically during Republican cycle, for the most part, the stock market typically does pretty well, historically speaking. So if that's any indicator, the stock market does well, that could be a bad thing for bonds. So it is going to be interesting nonetheless. I mean, can we see both do well at the same time? I guess to some degree, yes, but not at the levels that we've seen in the past.
I had another chart, Jeb, that I didn't throw in here because it really was stock market related. If you look at a lot of the measures, whether it's price to earnings ratios, any number of measures say that the stock market is way overextended and due for a correction. But this chart showed that when you have a 2-year bull run, like we've had, on average, it extends for another 3 years. So Jeb's favorite saying, the markets can remain irrational longer than you can remain solvent. I wouldn't necessarily fight the bull market right now, for what it's worth.
No, good stuff. Let's see here. We got S&N Media Production. Long name here.
Very long. It sounds like
are
two
you adding more to
businesses.
that thing every week? Do you know why interest rate is going up when the Fed already cut by 50 basis points and projected to cut by another 25? I don't get it. Aren't rates supposed to be going down? So, Josh, we've talked about this. We've actually done a podcast on this. And with that said, let's kind of back up and talk about what we talked about prior to the Fed actually cutting, rates at that time. We were very transparent in the Fed's transparency, in expectation. So, because they've come out and they've been very clear, this is what's going to happen. Now, they didn't say they were going to cut 50 basis points, but they did say they were going to cut. And so what the Fed is doing by, the dot plot and the different things that they put out is give the market an indication of their thinking, where they're headed, which leads the market to trade on that news sooner than later. They don't trade on it the day that it happens. Typically, they trade on it prior to that because of the expectation of what's going to happen. That's essentially what's happened here. A lot of what happened with, Trump and the presidency started a week and a half ago, when the idea of a red wave, winning Congress and, the presidency was going to be potentially inflationary for the market. The market started to trade on that. The 10-year, I don't remember the exact numbers we were at, Josh. You probably have a better idea, but we went from like 4.1 to 4.3. And then overnight, we went from 4.3 to almost 4.5 last night once that was confirmed. Now, does it go higher from here? I almost think a lot of it's built into the market, right? I think what the market's expecting is already built in there, unless the Fed comes out and says something crazy tomorrow, which I don't expect to happen. I think we're probably towards the top end of that range, but I don't know. What do you think?
So here, Rakesh just follows. It's a follow-up question. He just joined, so he didn't know what you were answering, but it's kind of a follow-up. It says, is the bond yield going up because of inflation going back up with Trump as president, or is it because it's pricing in less rate cuts in the immediate near future because of the data? So think about, why is the Fed cutting? They were cutting because they had rates so high that they were restrictive. They're not trying to lower them to make them accommodative. They're trying to take away that level of restriction.
And talk about what that means, Josh. What would be accommodative at this point? And talk about accommodative versus restrictive, because I don't think most people understand where those numbers need to be. They could cut almost 2%, over 2%, and still be restrictive because of where
we're at 5% on the Fed funds, and inflation, depending on which measure you like, is 2.5. So you are double that. So the real rate is like 2.5. We went years with negative real rates. So negative real rates, where rates are lower than the rate of inflation, that is stimulative. They are trying to get people to put money at play, make it super cheap relative to inflation to borrow. Well, it got so expensive relative to inflation that no one was borrowing. So they're just normalizing. So somewhere beneath where we're at right now. So if we get 3 more cuts, 4 more cuts, I believe was the total projection in the Fed funds future, you're still at 4%. And if we have inflation at 2.5, that is not a stimulative number. So that's where they're trying to go. Now, at the same time, what is happening with bond yields, whether it's the 10-year that we watch because it's a little easier for you guys to track at home, or mortgage-backed securities? What's happening with that is that the market is saying, we're worried about inflation. We've talked about this in the show. We've had 4 years of Trump. He got his tax cuts before. He had some tariffs put in place. It wasn't inflationary. So to me, it's funny that they're looking at, oh my God, this is going to be terribly inflationary going forward. It might be, and the market's going to make up its mind in the near future. But the bigger macroeconomic trends of what happens with the employment rate, does the market keep humming along? Does unemployment stay really low, or and GDP up over 3%, or does productivity moderate? Does unemployment go up? All of those things are going to come into play. Right now, I think what we've seen, and I'm hopeful like Jeb that we've already priced in the worst of it, is the market has said, what's the worst that could happen? We fear this is the worst, and we're going to price for it, and then we will let time tell us that wasn't as big of a fear as we should have had.
No, good stuff. And yeah, I mean, these questions are going to continue to come up, and we can answer them more. But in order to keep the show kind of moving along here, we'll answer some more, and if we got time, we'll kind of come back to it because there's more to that question that we could talk about. But in order to get to additional questions, we're going to address some other things, and then we'll come back. So, recommendation on when to purchase in the next year. Whenever you can find the right property, right? Don't try to pick the top or the bottom in the market, right? The nice thing about buying a property when you find it, assuming you qualify, assuming the payment makes sense, assuming, you have all the things that we've talked about several times, is that if rates go up and prices continue to stabilize and or go up 1, 2, 3%, you've locked in worst case scenario. They come down, you're still in a position to refinance. You can take advantage of lower rates. You've already locked in the price of the home. Chances are prices are going to continue to go up. My guess, again, I've said this for the last 5 years we've been doing the show, 4 years we've been doing the show. My guess is home prices are probably higher next year the same time than they are right now. Now, does that mean the entire United States, every city? No, it doesn't mean that. But as a whole, the median home price is probably going to be higher this time next year than it is right now. So you have that opportunity to do it. I don't think there's and we've actually done an episode, Josh, where we talk about buying in the spring versus buying in the fall. Typically, if you buy in the spring of a year, you get the property at a lower price, even though it's a little bit more competitive market than buying later in the year, because most of the appreciation happens in that March to May, June timeframe. So if you can get in before prices go up, no guarantees, then essentially you're going to be in a better position than you would later in the year.
And sort of the secondary thing, Jeb, that follows from that is this marry the house, date the rate. There was a really good article in the LA Times about 120 days ago, right before rates started dropping, of people that were full-blown panicking because they did that. They took on mortgage payments they couldn't afford. They did a buy down that was going to expire that they couldn't handle. So it's a good idea, it's a good thought, but only if you're okay if it never happens. It's a bonus or a benefit. We just went through a rundown here where we were able to help 20 or so people who bought in the last 2 years at much higher rates roll down. Probably one of the best examples, Hayden and Katie, a listener to the show here, helped them buy like October of 2023. It's like when the rates were at their absolute worst. In the spring, we rolled them from 7 3/8 to, I think, to like 6.75, 6.875, no cost. They paid nothing.
You also have this one, Josh. You can read it when you're done talking about that one.
Okay. And then just here recently, rolled them down to, I think, 5.899. Again, no cost. That's the best case scenario. You can't plan for that. You can hope for it, and you can plan for it. You can't count on it. So be aware of that. I agree that home price appreciation should continue to moderate. We shouldn't see what we've seen over the last 2, 3, 4 years. But with that, there's going to be opportunity. There's going to be dips where you can benefit from a lower interest rate. So if you're comfortable, you can handle the payment, go ahead and enter the market here before we get to the spring buying season, because that's going to be the least level of appreciation, the least level of competition. And that is in no way for you idiots out there tapping away saying these guys make their money doing real estate and mortgages and they're spreading fear of missing out. Never buy out of fear. And if you feel like someone is putting fear into you, just go away. Is it the right time in my life? Can I afford this? I'm planning for this and hoping for the best going forward. But it's funny, Jeb, we've seen Jay Homeboy here for what, 2 years? 2 years here in yeah. And I just closed the loan for him. I don't get screen names are hard to connect to a real name. Now that he says Josh is the man, just closed on a refi going from 7.5 with a 1.1 buy down to 5.99, lower my monthly and
now
shorter
you know
term,
who Jay Homeboy is,
having a very short break even point. So now I know that's Jeremiah Homeboy. So I appreciate it.
You just gave away.
I outed him. I doxed him.
You can't do that, bro. That's like he's got to change his name. You got to change your name now. Anyhow, appreciate you being part of the show, trusting Josh and the team to take to take you down in rate. So good stuff. With that, Josh, what do we have here? We've got this is a good one. We don't get a lot on student loans and that sort of thing, but let's talk about this question. Does tuition paid for private school for K through 12 count towards your DTI calculation? So Josh, somebody pays, they're in private school, is that something that you're going to see that gets calculated into their monthly debt to income calculations?
So there's a couple of important thoughts here. We have to be aware of it to count it into your debt to income ratio. And once we become aware of it, then we have to see that it is an obligation. It's not something that you can get out of. Now, if you had a contract to send your kids to a private school for the next 12 months, it could possibly become a problem. But for the most part, if next month you can't pay your bills, you can say, hey, kids, we're going to the local public school because mom and dad can't afford this anymore. So for that reason, we don't count private school payments against you because it's voluntary. It's optional. There's not a contract involved there. Now, let me give you another example. Had one pop up here for someone we're doing a refinance for. On their bank statement, it said like housing expense or lease expense and another person's name on it. We're like, what in the hell is that? So the underwriter asks, well, it turned out they gave their parents $1,000 a month to help offset their housing costs. But there was no lease. They weren't on a lease. They didn't have any obligation. We just had to explain, I voluntarily give my parents $1,000 a month. And if I can't pay my bills, I can stop paying them that. Now, if it turned out that that was someone that had a girlfriend on the side and signed on a lease and we have another lease payment over there, that's going to be an issue or a problem. So if there's not an obligation, obviously the things that we have to count against you, anything that shows up on your credit report, installment loans, revolving loans, credit cards, student loans, any of that stuff that shows up on your credit report. But some things can pop up through a bank statement. So from my perspective, Jeb, I really like the tools that we have now where you can do asset verification, where you're seeing more of the average balances and not all of the daily activity. Not that we're trying to hide anything, but the more automated and the less granular documentation we can have, the less likely it is that something is going to pique the underwriter's interest and make them ask questions.
No, that would be rad though, that if you couldn't qualify and you told your kids, hey, you can no longer go to private school, you have to go to public. That just like perfect. The kids will remember that forever. I mean, like just a timestamp in history when they go back and tell stories. Anyhow, no, that would be cool. I was joking. Question: where do you see housing going in the last few months of the Biden administration? Up, down, sideways? I keep thinking this government will let everything go just to hand over a bad market. So let's talk about, is that possible? What can the current administration do anything to impact the housing market? And the reality is no, not in the next 2 months. Who has control to do anything to the market? I mean, I guess the Fed has some impact on mortgage spreads and things that could impact mortgage rates, but the reality is nothing is government wise could probably have a negative impact. But you have to also understand that things don't happen immediately, right? Like, when Trump gave $2.5 billion or whatever it was during the pandemic for stimulus, that didn't impact the market with inflation then. It impacted the market with inflation a year down the road, right? When somebody else is president, which then got added to more stimulus at that time. And then it really became an issue with all of the other stimulus that was added onto it. So things that happen, like Josh said earlier, don't necessarily, the good things, they get way too much credit. The bad things, they get it's offset and they're the worst people ever. The reality is a lot of what happens now doesn't happen now. It happens months down the road. So I guess to reframe that question, Josh, is there anything that they're doing now that's going to have a negative impact 3, 6, 9 months down the road?
You've heard the difference between, hey, if you're ripping around in a speedboat, it's pretty easy. I can turn around and go the other direction on a dime. Well, this is the biggest of all motherships. Like you've got 3 months, 2 months. There's nothing really they can do to tank anything. You don't want your legacy to be anything other than positive. And remember, Kamala is probably really sour today that she lost. Her relationship with Joe Biden wasn't great over the last 6 months. He wasn't even there at her party last night. So from that perspective, I don't think Joe's sitting around going, how can I tank this because my girl didn't win? I would like to think the better part of human nature that none of them would think that way. They all go into public service for the better good of all of us. A little Pollyanna-ish, but no, I don't think they could, and I don't think they would either.
No, and so with that, the market status quo probably until you see a change in rates. You got to understand seasonality is in play, right? The next couple of months would naturally be a slowdown in the market. You know, what most people remember though is they remember 2020, 2021, 2022, 2023 to some degree, but you're now getting normal cycles in the market again, quote unquote normal, right? So we would normally see the market naturally slow down this time of the year, which means less transactions, which means homes coming off the market, inventory coming down, homes sitting longer, and that continues. It doesn't change over January 1st. Takes until about third, fourth week of February after the Super Bowl till you start to see the market change again. So what you're seeing now is probably the market for now, unless rates come down considerably, not likely to happen, or rates go up considerably from here, which that would only probably have more homes coming off the market than on the market. So I think status quo for the time being. Josh, question here from Adrian saying, have the Feds ever dropped the rates 50 basis points after an election? And I can only remember one time where they've dropped the market even 50 basis points, and that was the last when they just did it a month or so ago. And before that, they did 100 basis points during the pandemic. Outside of that, in my knowledge, in my memory, it's mostly 25 basis point cuts. Is there anything that comes to mind on your side?
No, and especially around an election. So they only want to do slow and deliberate. Anything more than 25 basis points is kind of a sign of a little bit of a panic. They did a pretty good job of explaining why 50 basis points was appropriate at the last meeting after an extended period of elevated rates. So from that perspective, they don't want to do it, and they don't want to do anything that could be appearing partisan, cutting right before or right after an election. And they did just do both. They did cut 50 right before the election. Thankfully, the market absorbed it. It didn't become an issue in the election. They're going to cut 25 basis points tomorrow. Trump's president, so he can't be mad. He can't say that because he did during the campaign, during the summer. He's like, they need to lay out until after the election, and we'll see what happens there. So from that perspective, they want to be as nonpartisan as possible. They want to move as deliberately as possible. So highly unlikely. We could look it up, but I doubt it's ever happened.
All right. Question about a HELOC here, Josh. What do you think about using a HELOC to acquire a second property for a rental? They need roughly $100,000 to make the monthly payments possible. So, Josh, problem with home equity lines in this environment is if the Fed's not cutting, the rate's staying the same. Would you use a home equity line of credit at this point to offset or to get that $100,000 to get the property cash
This specific question, there's something really important here. I need roughly $100,000 to make the monthly payments possible. A HELOC doesn't meet that. They're not handing you $100,000 saying, cool, just get it back to us whenever you get a chance. You're going to make monthly payments. So you're not getting $100,000 that's going to lower the monthly payments. It's I have so much payment. Where's my camera? I got so much payment over here and I got more payment over here. So you just have you have the payments going a different direction. So it doesn't solve the problem. I have no problem with using a HELOC to access your equity right now to make other investments. The most common one we're seeing right now is divorces. So spouse is going to take it over. They need to buy out the other spouse's equity. Talked to a woman this morning. She's going to buy out her husband. $365,000 loan at 2.75%. They're not touching that thing. She's going to take $250,000 out at 8%. So to your point, Jeb, much higher interest rate, and give him that money. And we'll look for an opportunity to consolidate both of them together if that ever makes sense, or to refinance that second to a lower rate at some point in the future. But in this situation, it's not free money. So you're still making the payment, whether you were able, like, let's say that $100,000 is a 20% down payment on the other property. It's really like 100% financing. So if the 100% financing was available on that property, it's still going to have a much higher payment than what you're comfortable with. So you're not accomplishing the goal there of lowering the monthly payment.
So, Josh, in order to keep this short, we've talked about this, but there's two questions on it, so I'm going to throw them both in here. Let's address this quickly. But the questions are both about buying new construction. One has it closing in May and asking if they should lock now. The other is closing in December and asking about locking now. So what's the advice on based on the volatility in the market right now? Short term being December, should you lock? Long term, May. What's your thoughts on both of those?
You and I looked at the chart this morning and said, "Whoa, that's ugly. There's nothing good there. There's not a thing you can look at and go, this is good." With that being said, if you're unlocked right now and you have that short-term time frame to December, I would probably, and this is me, I watch this all day, every day. I understand it fairly well, and I know there's risk there, and I would be comfortable with it. But if we're at 445 or wherever we ended on the 10-year today, 450 should be a line in the sand. It's not guaranteed to be. So I would be comfortable floating as long as the 10-year stays below 450 and giving it a chance to hopefully recover after this big move in the other direction over the last couple of months. The bigger question for the person who is closing in May, the lender is offering a lock right now as a hedge, but there's a fee. So most of the times there's an upfront fee that you would lose it if you didn't close. But if you close, it's going to be credited towards you at closing. So I don't like paying an upfront fee, but as long as it's credited to you, it's not an additional fee. It could certainly give you a level of comfort and confidence. Go back to 2016. Trump was elected. He had the House and the Senate. He made it really clear he was going to raise taxes. People thought, or lower taxes, people thought that was going to raise deficits and increase government spending, cause inflation, be bad for bond yields as a whole. And we had like 6 to 12 months of just steadily grinding higher in interest rates. So that's definitely a possibility. I wouldn't argue against an extended lock in that case, just because I don't have a strong comfort level. We've looked at the chart, Jeb, twice we got into the high sevens. So you could easily be a half to 3/4 of a point worse. We've seen it happen within the last 2 years. It's not like you could say, "Oh, that's crazy, never going to happen." So from that perspective, you got to go with your risk tolerance and what that looks like.
Yeah. I mean, me, December, I'd probably lock. Me looking at May, I probably wouldn't, but that's me, right?
So
I mean,
tell me, okay, tell me why you wouldn't look at it the same way that I do. It's not going to blow through 450 in a moment's notice. So it's less than an eighth of risk. And
I just don't think the market can move enough to really change rates at this. I mean, what's going to come out that's going to make it go down, right? Trump's not going to get elected until January, or he's not going to go into office until January, right? So the idea of his policies being inflationary, we're not going to know anything. We have zero knowledge of truly what he's going to put into or try to get signed off until a little bit later. In fact, we don't even know if he's won the House yet. So until we get that, we truly don't know anything. And that's a week or so out. So you're already eating up part of that. You got Thanksgiving, you got some holidays in there. So I think, what could cause the market to come down in a meaningful way? News-wise,
in the next
war,
7 to 14 days,
right?
The Democrats could win every one of those seats in Congress.
They could. We've already said it's not likely. So
already said it's not likely. So
right.
Here, for you watching at home, what I want to say is Jeb's not wrong. I'm not wrong either. Two people who follow this on a day.
But I also am more of a gambler than you are, right? I'm willing to risk, and I'm okay knowing that there's a potential for a loss. I don't like loss in rate, but just like when I bought the house back last year, I messed around. I almost used a different word there. I messed around and ended up with a 7% rate at that time, when I could have started with a 6.75 because I thought rates were going to come down. So I took a higher rate. And do I need to do that?
No,
and
no,
you're fine. It gambled and lost. So you got to just know your risk tolerance. So that's all that's said there. Just know who you are and be okay with whatever it happened. You don't have to be okay with it, but yeah. So anyway, all right. Josh is a good one here, asking about 401ks and IRAs for down payment. So we get this question a lot. Most people don't understand how much they can take out on a 401k, and IRAs obviously have to understand with Roths that the property has to be purchased in the Roth. So it's a whole different deal there. So maybe talk about both of those quickly and help people.
Well, he's talking about using it for a down payment. So with the
Yep.
401k, again, you can borrow up to 50,000 or 50% of the balance. So if you have $100,000 or more, you can get up to $50,000. I love it. It's a great idea. You don't have to use your liquid funds. I mean, if you don't have $1 to your name, I don't love it as much. But if you have $25,000 saved, but you can get 25,000 from your 401k and pay yourself back and keep $25,000 as reserves in your bank account, I like that better than taking yourself down to zero or close to zero. The Roth is very interesting. So you have to think of the way the Roth works. You're making contributions, you're taxed when you make that contribution, and then it grows tax deferred and you can take it out tax free. So because it's already been taxed, your initial deposit, you can take any and all of that you want. So if you've made $40,000 of contributions and it's grown to $100,000, you can't take all 100, but you can take the 40,000 out and leave the other 60 to grow and not have to make a repayment. I like the repayment better. So you're making a loan to yourself at a lower interest rate than you could otherwise access the funds and keeping your retirement on track, because both are equally important. We probably should, Jeb, do a show on that at some point. It is important that you become a homeowner, fix your housing costs, and get that paid off prior to retirement. But at the same time, you need to be growing your retirement savings so that you're independent financially when that time comes.
Now, you can do that with a 401k, but can you do that with a Roth as well? Can you borrow from your Roth without
I don't know
having
if
to pay
you
taxes?
I don't know if you can borrow
can.
from it, but you can take the
It'd be a
contribution.
penalty
You can't
though.
take the growth. No,
No?
you can
Okay.
take your contributions. You cannot take the growth.
I
If you
got you.
take the
Okay.
growth, you're getting taxed, you're getting
Gotcha.
penalized and taxed, but your contributions you can pull back for buying a home.
And do you have to repay those into your contributions? Do you have to
No.
repay those on the Roth? You do not.
No.
Okay, got it. So you're just basically pulling out the compounding part of your Roth there, which, depending on what you're looking at, and maybe it makes sense, maybe it doesn't. So, depending on what you decide to do there. All right, Josh, what do we got here? Go ahead.
We've got a comment here, and we saw this today. So Edward Smith says Trump will lower gas and we will become energy dominant. So get ready for 4 great years. Oil prices tanked today, so there's truth and there's logic to that. We saw it his previous presidency, and oil filters its way through to almost everything, and it affects inflation in many ways. So there's two sides to it. The things that, higher tariffs, and we didn't talk about that in the lead, Jeb. We can go through this in tomorrow's podcast episode, but tariffs are not inflationary over the long haul unless you keep ratcheting them up. We talk about inflation is a rate over time. It will cause prices to go up in the short run, but if you put a 50% tariff on everything, obviously the people selling those things are going to increase the price. But after a year, it's not like they're getting another 50% tariff and another 50% tariff.
Correct.
Prices will level at that new level. So it would be inflationary in the short run, but it wouldn't be inflationary over the long haul.
Yeah, and I think it's important. Like, most people don't understand how tariffs are paid. Tariffs aren't paid by the people shipping the goods, right? China's not paying the tariff per se. It's whoever it's being imported to is paying that tariff, right? Which means if we're getting T-shirts from China, for example, and the tariff goes up $2 and we're paying $10 a shirt. Now, those shirts are now going to be $12. They're passing on that cost to the consumer for the most part. So in the short term, it could be inflationary. Like Josh said, we don't know what those tariffs look like. We don't know the cost of them. But over time, remember, inflation is not a continued rate of what is it? It doesn't continue to what am I saying here, Josh?
When we look at
basically
inflation,
like
it is a rate of change in the
there we go, the rate of
prices,
change,
and you're achieving the tariff should take you from here to a new level.
There.
And
exactly.
that would be
unless there continues to be tariffs go up every year, and in which case it would continue to get passed on. But just because milk goes to $5 and it stays at $5 doesn't mean inflation is still there. That's just the new price of what milk is. In that case, the tariff is built in. So we'll see what all that looks like. It's going to take some time. Again, none of this stuff happens immediately, guys. And that's, I think, the biggest idea is that, hey, he's going to come in and all of these things are going to happen right then. No, it's still got, there's bills, things have to pass through. It takes some time for all of this stuff to have an impact. But I would imagine energy costs would go down. with oil and some other things
It's
in play.
complex, right? There's a lot of interactions here, and the market is assuming it is one way. If you look, the U.S. is largely a service-based economy. I saw a number last week. It's roughly 7% of the economy is subject to tariffs. If everything got slapped with a tariff, it's about 7% of the economy. So from that perspective, it does seem like the fears are overblown, but that's what markets do, right? They get news, they analyze it, they overblow whatever their fears are, and then it corrects over time. And I think that's likely what we're going to see. So with that, Jeb, with that thought, Tino would like to know, where could we expect rates in 6 months from now? Which we led off the show with, there has never been a more difficult time to forecast. We don't have a crystal ball, and I don't know that there's ever been a more difficult time to forecast what's next.
I don't know. I don't know the answer to that, Josh. I had a pretty good idea going into the end of the year that we were going to see rates, sub 6 by the end of the year. We saw rates sub 6, but it didn't stay there
for about 6 minutes.
Yeah, they
sub 6
down
minutes,
and then they went back up. Where do rates go now? I have to believe. I mean, because of Trump being a businessman and trying to stimulate the economy, he knows that we have to have lower rates in order to really get that stimulation.
He's on record hundreds of times saying I love low interest rates.
Yes. So, but the question is, how does he get them down there?
How do you get them?
How do you get them down there?
And will he?
And I think he wants them lower. The question is, what can he do in order to get them there? And that part is kind of out of my wheelhouse at the moment until you see some policy that would change that. I mean, one thing is a tanking economy would allow rates to come lower, but he also doesn't want to see a tanking economy either, right? So, because that's not pro-business. So it will all be very, very interesting nonetheless. So Alejandro has a question about buying a house. Josh, if somebody gave you a 3.99% rate today to buy a house that you didn't really love, would you still buy it?
Simple rule. If you're going to live in it, never buy a house you don't love. You could talk me into buying a rental, an investment property that I don't love. If I got to live in it, there's just no world. It can impact your life and your happiness in so many ways that find another builder that's building somewhere, and maybe they're giving a 4.99 rate. And is that a big difference? It is a big difference, but you can't put a price on happiness. We're trying to put a price on happiness right here, Jeb.
Yeah, and also remember your 3.99 rate is actually like a 4.5 rate or so, just because of mortgage insurance adding on there. So it's, because it's an FHA loan. So your rate's actually going to be, your effective rate's a little bit higher. I mean, you're probably factoring that in, but just, for comparison across the board, you gotta factor that one in. So anyway, Josh, buy now, pay later. Know anything about it and how underwriters look at it?
So it's not captured in your credit score, so it doesn't impact it that way. So we go back to what we talked about earlier, the private school. How does an underwriter become aware of it? If we see a bunch of money coming out of your bank account every month because you're the buy now, pay later queen, and you've got 50 of these things out there at different places paying for your jeans from last year, your couch from last month, they're going to ask, they're going to go, what in the hell is this? Why is $150 coming out of your account every month? So it won't impact your credit score, but it certainly could impact your debt to income ratio if they're looking at your bank statements and seeing those same withdrawals month after month.
All right, good stuff. What do we got here? What do we got here? I think our biggest supporter is Dixieland Production, if I'm being
the thumbs up honest. Every time we post something.
Every time we put a video out, comment, say they're there, like it, so, everything. So, to our biggest supporter. Good stuff. So we appreciate you showing up and liking and continuing to comment on everything. Josh, if rates go down, do you think property values go up? I think people look at the monthly payments, not the cost. Thoughts. So there's definitely some truth to people living in the payment and not the price. So if a lower interest rates allows a lower monthly payment on a higher price property, is that real? Does that how prices get pushed up like they did during the pandemic?
How many times have we talked about on the show? Supply and demand, right? Demand is absolutely impacted by affordability. can I afford to buy a house? So if you had rates come down, so demand went up and there was no equivalent supply coming on board, it would push prices higher than they otherwise would be. The working theory that most people have is that if rates come down, it's going to unlock some of the owners who feel like they're trapped with their current mortgage, and at some level, they will bring that supply to market. So it it can't do anything but help. It certainly wouldn't hurt. I think it's more likely to impact sales volume than price appreciation, but it would otherwise be a positive. There's no way to say. We saw, Jeb, over the last couple of months that when rates drop 1%, sales volume and home prices go up. So it would impact it. I don't think it's going to have a huge impact. I think affordability is at a point where no one is going to go, whew, thankfully rates went down 1%. I'm going to overpay for this house. Everyone is pretty bottom line oriented at this point.
Good stuff. If a builder's lender is giving you $25,000, is it better to use that money to buy down the rate or apply it towards closing costs? Or Josh, is it one in the same?
Well, the buy down ends up becoming a closing cost. And then once you're at $25,000, you have exceeded your closing costs. So that's what I see from all of you reaching out saying, hey, can you look at this? Hey, can you do better? First of all, no one's going to do better than a builder giving you $15, $20, $25, $30,000 incentive to buy the house using their financing arm. Generally, if you compare apples to apples, it's about a 65% of that credit they're giving you is what it would be equal to if you went out on the open market. But still, it's real money. So from that perspective, I would love to just use the money to pay the closing costs, so you have no sunk costs at all in that loan and be in a position to refinance going forward. Most people end up with excess funds. So whether they're doing a permanent or a temporary buy down, they're going to use those funds to buy the rate down in addition to covering all their closing costs.
So let's talk about Ed's
hold on, but before we do that, I'm telling you, I look terrible here. And Kim says my screen looks like I'm on dial-up internet. It is not the internet problem. What in the world? My computer, my damn camera went out of focus about halfway through this, and it will not come. Look, there I am. I told you. I tried to get it.
Seems fine almost.
No, now well, you're looking at me in a postage stamp on your little thing, but it went out of focus.
I try not to look at you.
Kim, thank you for confirming, because I knew I looked fuzzy for the last 20 minutes.
So Ed's comment here. Let's talk about this too, because we've talked about things that could impact the market. Talks if corporate tax if puts corporate tax at 15%, then many of these suppliers might put factories in the United States, which will produce jobs in America and better prices on goods. So if jobs come to America, Josh, in a time where the economy is suffering, where employment is going lower, unemployment has been going up, historic, I mean, over the last 6 months to a year, right? It's up. Does this slow down producing jobs? That's a good thing for the economy. Does that change the direction of the Fed, right? So we got a lot of things at play here. Does the Fed now look at the market if jobs are being created and think, hey, the market isn't suffering nearly as much? The soft landing is off the table. We don't even have a landing. We're in a growth economy. What does that do to the Fed fund, lowering the Fed funds rate? Are they still restrictive, or do they keep things where they are? I mean, or do they lower?
Let's think about, like, the theme of tonight's show is really just uncertainty. We have certainty now that we know who won the election, but the uncertainty is now shifted to how does it impact? What Edward is saying, 100% correct. What the markets are fearing, potentially 100% correct. What we just don't know how it all plays out. What the firm plan is, what happens to the plan when it goes in front of Congress. Do we get it passed? What does it look like once it goes through that entire process? And then when it hits the street, how does it impact everything? There are positive things here in addition to the potential negative things. So that's why I'm concerned, not concerned like, oh my God, the world's going to go to hell in a handbasket over the next 3 to 6 months. I'm concerned that it's going to take some time for us to get a decent handle on how big is the mandate after last night's election fully plays out in 2-3 weeks, and we see what it looks like. What does it look like when he gets in there in January, and what do those plans look like taking shape? And then what do they look like when they actually get passed? Because all of these things are true and correct. And I think any of us here are just speculating. So you talk about what your view of it is sort of your lens. If you voted for Kamala last night, you're like, yeah, he's going to put tariffs and the economy's going to go to shit and it's all going to be terrible. If you voted for Trump last night, you're probably saying what Edward's saying. And neither of them are horrifically wrong. They are a potential outcome based off of what we know today, but we're only going to find out over time. I would defer to history and say we have 4 years that ran pretty well. Now, it's not the exact, you're not going back to the same setup, the same scenario. So
Right.
it's going to be different, right? The same person doing the same things in a different environment is going to produce a different outcome. So I'm not saying we're going to get a repeat of it, but we have a pretty good look at what it's going to look like from that perspective.
Good stuff. So the title of tonight's episode was how high will mortgage rates go? Josh, in the short term, rates are just above 7% right now. Well-qualified buyers probably right at 7, maybe just under. Can we see a run at 8% again? Is it possible? I mean, it's definitely possible. Is it likely? Where do you think we are over the next 6 weeks to a month?
Jeb, I've told you over the last 6 months, I have been possibly the biggest bond market jinx there is. So I don't want to say anything positive, because when I say positive things don't happen. Maybe it just tells you that I don't know what I'm talking about. It could be a possibility. We'll probably get confirmation of that in the comments that yes, Josh does not have any idea what he's talking about. I would like to think that we hold here at 450 and continue to see the downtrend. When we had that really big pop down, if you guys remember, I looked at it and go, this is a little too much too fast. I wouldn't be surprised to see us give some of it back. Now, I was shocked at how much and how fast we gave back. But it's just going to take longer to get to the inevitable end. And whether that's 1 year or 3 years from now, we're going to get really good rates at some point during Trump's presidency. And that's not because Trump is magic. It's because that is the trend of the overall economy.
Here's the deal. Volatility is in the market to stay. It's not going away anytime soon. In fact, you'll probably see more volatility over coming months. So, if you're in the market, you're unsure, lock your rate. Don't float. Don't play the game. If you're trying to pick the top or the bottom, buying houses, also a fool's game. Buy when it's the right time. Have that longer term time horizon. We showed that chart earlier. I know most of you weren't alive 40 years ago. I was barely alive 40 years ago, but the reality is home prices over time do very, very well. So you can buy it, hold it for extended period of time, you're going to be just fine. And don't worry about the daily fluctuations, because again, it doesn't matter. If you have a payment, you need a house to stay. I mean, you got to have a roof over your head, right? So just plan accordingly, be comfortable with the payment. And if Josh and I can help you, there's a referral link in the description of this video. But until next week, adios.
Amigos.